Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. On today's episode, we're going to be discussing the economic outlook. So we're joined by Jennifer Lee from BMO Capital Markets, who's going to give us an idea of what's in store for us this year, a look at some of the risks we're facing in the markets, the odds of a recession, inflation, and so much more. So just as a reminder, before we get into things, we are not providing you any advice or investment recommendations. Today's episode, like all of our episodes, is just about providing education around the markets for Canadian do-it-yourself investors. A quick reminder to please check out our YouTube channel. You can watch any of the episodes that you may have missed here, and make sure you subscribe and ring that bell so that you are notified every Friday at 1 p.m. as we go live. All right, welcome, Jennifer. It's really great to have you on here. You were on in the summer talking about inflation, and here we are again.
That's right.
Yeah. Jennifer's the managing director at BMO Capital Markets. And you've been with BMO Capital Markets for over 2 decades now. And I have to admit that I really enjoy your sort of straight shooting, easy to understand way of breaking down complex issues. So really looking forward to our discussion today. All right, so we're going to jump right into it because we've got a lot to cover. So Jennifer, I think just when we started thinking things were sort of becoming a little bit normal, we were hit a couple weeks ago with the turmoil in the financial space with US banks really dominating the news. What are your thoughts on that? And what are you seeing as sort of the key risks in the market today? And then second part to that, is there light at the end of the tunnel?
Oh, well, might be a very long title. We'll have to see how that goes. Thanks for having me on this week. So we've had a few days of calm in the market so far, but like I said, this could be potentially a very long title with maybe some air vents stuck in between. But I feel like there's always something, right? If it's not the pandemic, it's the war, and now there's this banking sector crisis. And we always have to remember that this particular episode had dealt or is dealing with very specific problems to these now infamous banks. Silicon Valley, very heavily invested in these ultra safe treasuries, but obviously they failed to manage their interest rate risk and their liquidity risk. The other couple of banks, Signature and Silvergate, very much crypto focused. Credit Suisse, they had their own quite a few years worth of scandals, I guess. I mean, even I think it was last October, there were some rumors that they were going bankrupt. So, and of course, now the rest is history. But I think all of this new episode in particular, is going to add a few more white hairs to the heads of Fed Chair Powell and Treasury Secretary Yellen. But I think it's pretty safe to assume that we can expect more regulations, more scrutiny, particularly for the regional banks, which may not be a bad thing. But in terms of for our purposes in economics, this calls into question what the Fed is going to do, what the Fed is going to handle it. Are they going to keep their eye on the financial stability ball and just start cutting rates, which could potentially spark inflation? Or are they going to keep their eye on the inflation ball and keep raising rates or keep rates high so that inflation doesn't spiral out of control? Now, just given their decision at that last meeting on March 22nd, I think their answer is a little bit both, but mostly focusing on CPI, one of their mandates. But of course, depending how things follow, I feel like it's almost like a case of whack-a-mole when you're trying to deal with one thing and another thing pops up. So we'll have to see how this thing plays out. But certainly the markets, the views of what's going on has been flip-flopping, and we're all getting a big case of whiplash. Just earlier this year, there was all this talk about inflation, and that remains very sticky. That's still the case. But at one point, due to some very strong economic data that we're seeing out of the US, there was some talk about a 50 basis point rate hike. That was coming back into vogue. And of course, all that changed overnight. The whole narrative changed with the collapse of SVB and now rate cuts are back into the conversation. So you'll have to understand how difficult it has been really to make calls in this kind of environment. But I think the main takeaways right now is that we have to still keep watching the data, because yes, they still matter. And my big fear right now is that that there's going to be some panic, and when you start to act irrationally, then things can go south in a real hurry. So here's an interesting factoid for everyone out there, just to show how much volatility there has been in markets recently. In the 2 weeks, the 10 days that followed since the SVB collapse, 2-year treasuries plunged by about 150 basis points in that short span. And we normally don't see those kinds of moves unless they're in pretty huge situations such as 9/11 or the pandemic. So this is the kind of volatility that we're talking about. So obviously, this is sort of adding to the list of things that we continue to watch. There's always, like I said, always something to worry about. The banking crisis, of course, even though there's some calm recently, markets are still a little bit jittery. Inflation remains still very, very sticky, especially on the core front. Interest rates, how much higher are they going to go? Are they still going to remain up there for a long time? Probably. China's reopening, whether or not it's going to be inflationary and what it's going to do for the global economy, that's still a question. All this, the war and geopolitics, that continues to drag on, with Putin seeming to double down, I think, on the war. And then the constant threat to Europe's security is an ongoing issue. Tensions, of course, between China and US and Russia, Russia and Europe, all these geopolitics still play in. This whole discussion about globalization and deglobalization, I was hoping that would be put to bed after the last trade war, but I think the pandemic, if anything, deepened those discussions. And now we've got more of a focus on domestic production, like the Buy American concept, or the CHIPS Act, the latest CHIPS Act, which caps the amount of money that U.S. companies can obtain from this fund, assuming that they do not have their chip manufacturing activity elsewhere outside of the U.S. And of course, China, meantime, is also giving its chip makers a little bit more power. They're calling them the chosen few, and they're giving them access to state funds and state-owned research. So a lot of this is all playing out into the whole deglobalization theme. And meantime, there's also climate change, and that's something that is long-term, and yet it's not long-term, and it's still a very important issue that continues to play out. I would like to say that things are sort of coming back to normal, you would think, because Greta Thunberg seemed to have disappeared all throughout last year, and now she's back in the news again, trying to make the world a better place.
That's very true. She did disappear there for a bit, didn't she? Okay, very interesting. Definitely a good overview of some of the factors to consider, keep an eye on in the markets. I'd love your thoughts on whether you think we're getting closer to a recession and how that looks globally and here in Canada as well.
So globally, that's a good question. So globally, we are still not calling out for a recession, but I still think it's kind of close. It's sort of hard to have a hard, vast definition of what a global recession is, besides an extended period of economic decline and activity around the world. And if you had to put a number on it, here at BMO, we estimate it to be about 2%, in the low twos. So we have 2.5% growth pegged for 2023 globally this year, which is up a little bit from what we had previously at 2.3%. So it's a little bit further away from that 2% mark, but it's still, again, not far enough that it gives us great comfort. So it's almost like the smallest thing could potentially tip us into a global recession. But again, we haven't changed our call at all since this latest banking crisis took place. Even the big global outfits, like the IMF and the World Bank, haven't changed their estimates for growth yet. Again, way too soon. But the IMF did chime in recently, and they warned about the risks to financial stability because of this latest episode. But I think the focus is basically on confidence and making sure that there's still a lot of confidence in the banking system. So that's why we shouldn't be surprised that the Federal Reserve and the Bank of England, both in their latest statements, monetary policy statements, talked about how stable and resilient their own banking sectors were, which again is important to make sure that there is confidence in each country's banking sector. That is very critical. So no global recession yet, and of course, whatever happens in China, that'll have a say in the whole matter, and of course Europe as well. And it certainly helped that Europe had steadier economic growth over 2022 and into 2023. They managed to avoid a deep recession. Now, in terms of North America, I would say that we're looking pretty good in comparison, whereas up until recently, our biggest issue was that demand was way too strong. So we have been calling for a mild contraction, but right now there is still the risk out there that there could be a little bit more than that. But the fact is, I think that both North America and North America, Canada, and U.S., of course, have been very, very resilient. And this is after over 400 basis points of rate hikes in the span of just under a year. And the fact that the economies are still growing speaks volumes, I think, again, to the resilience. And this could be so for different factors, including, not just the lagged effect of monetary policy. We're not seeing all the full effects just yet of all the most recent rate hikes, again, just yet. Consumer spending continues to roll along, and that's due to the nice little pile of savings that is still out there. And that has been the unique factor, I think, in all of this. Canada is also the same factors, and our data, by the way, have been a bit mixed. But momentum has certainly slowed. Consumer spending has slowed because of, obviously high inflation and high interest rates. Housing market has been hit quite hard by all the rate hikes from the Bank of Canada. Export activity has slowed due to global demand, but it's far from being deeply negative here in Canada. Just the latest Bank of Canada's Business Outlook survey, even though it is for Q1, so before this whole banking crisis hit, of those businesses surveyed, 44% of those were still saying that they expect sales to be higher 12 months from now, and 33% of them expected sales to be lower 12 months from now. So on net, it's still positive. So, we'll see how this all plays out. But of course, again, how the banking sector stress plays out will also have a big say. We were talking about the 3 C's recently, how it plays out in terms of credit and whether or not it's going to become more scarce or more expensive, how confidence is going to hold up, whether or not it's going to hurt or how much it's going to hurt consumer spending, business capital investment intentions, and of course financial conditions, whether or not they're going to tighten up a lot. So again, still really early days. We are still looking for a mild contraction or a contraction of some sort here in Canada and US, probably negative GDP growth in second quarter, third quarter of this year, and rounding up to about 0.7% growth for all of 2023, and rebounding to over maybe about a 1.25% growth in 2024.
All right, very good. And what are you seeing in the jobs market and wages? Because I know that these are key indicators that you look at. What is it telling us about the economy moving forward?
So that's the one differentiating factor in all of this, is that the job market remains still very, very tight. We all know what happened. This all goes back to 2020 when we're all shut down and everyone was sent home. Millions of jobs were lost. And then, we had a big increase in demand for goods, and businesses were caught off guard. Try to get everyone back to work, but good luck with that. It was very difficult to do so. So fast forward to today, we've had a lot of retirements. People were retiring early. Maybe they weren't quite at that magic age yet, but there's a whole work-life balance thing going on, and people just wanted to decide that they had enough, and then they're ready to to call it a day early. A lot of boomers were retiring. Those just below the leading edge boomers, it happens, right? So through the passage of time, 3 years have gone by, and you're getting closer to that magic age of 65. But I think overall there's been this very much of a notable skills shortage. A lot of these industries lost a lot of workers during the pandemic. These are the industries that were under the most stress during in 2020, in healthcare and education. So now we are, and those are the sectors, by the way, that are finding themselves really short of workers. Early childhood educators, doctors. So apparently, there's going to be so many doctors retiring in the next couple of years, and that's a little bit of it's obviously a big concern, especially here in Canada. Leisure and hospitality industry is still short a lot of workers. Airlines, they're hiring people back, but they're still short, especially for ground crew. Construction industry, they were already having a shortage of workers even before the pandemic hit. So this has all made things a lot worse. And even in Canada, we've had population, the latest news is that we had population growth of over 1 million very recently. And a lot of that was due to immigration, but you can't just bring everyone in here and have them start work right away. It takes time to train. So all of this is keeping labor markets very tight. And you're hearing a lot of stories about businesses who are potentially hoarding workers. We're not going to let anyone go, keeping everybody on the payroll, which is not a bad thing, of course. This basically has caused the work or the job market to be very, very imbalanced, and this is causing a lot of wage increases as well, or prompting a lot of wage hikes as well. And that, by the way, is both good and bad. And I've been saying for some time now that if you're a worker, this is or was the best time to be looking for a job. But if you're a business, this is the worst time to be looking for a job. It's been or if we're looking for workers, I mean, it's been very problematic for businesses. They can't produce at full capacity because they just don't have enough workers. Meantime, unit labor costs are rising, the wage rates are rising considerably. So this is slowly improving now. We're starting to see a little bit less pressure now. Job vacancies are coming down, still very high, still very elevated in the US, still over 10 million jobs available, which outnumber the number of unemployed Americans by a factor of almost 2. Not as much in Canada, but still, again, they're all still very high, but they are coming down. And this is good, but at the same time, what we're trying to do is avoid some sort of a wage price spiral, because that can be very dangerous if that spins out of control. And so far, we haven't seen that happening. But that's what all central bankers are trying to do, is to manage inflation expectations, control them to ensure that we don't see this potential wage price spiral. So if anyone out there is still entertaining, several job offers, I would say take one, because this is not going to last forever. So I guess on the plus side of things, you can think about this in the way that if there are more fears about recession, then perhaps the wage demands would not be as high. So that would be good news on the inflationary front. But at least I will say this: at least consumers or workers are making a decent wage, and they can either decide to spend it or save it. But it's better than than the alternative, of course.
Yeah, for sure. Okay, I want to turn to inflation. It's been such a hot topic over the past year. Are we seeing it measure off, or are we out of the woods yet?
So the good news is inflation has peaked. It looks like headline inflation, certainly for both Canada and US, peaked in the summer of 2022. It's coming back down. Energy prices have come down. They're already well below levels that prevailed before the Russian invasion of Ukraine kicked in or began. So that's good news. But the bad news is not just about headline inflation. We're also looking at core inflation, which is when you strip out those volatile components of food and energy, and that's still very sticky. That's like the word of the decade. It seems like core inflation remains very, very sticky still. It's coming down, but not fast enough. Canada, we've got sub 5% core readings, core inflation readings. In the US, still about 5.5%, and there's a new one called supercore as well, with all these different components, still very, very high. So this is what the Fed, what the Bank of Canada is not happy about, and we need more signs that inflation is coming down. We need consistent signs, we need compelling signs, and we need convincing signs that inflation is coming down before we can ease up on the tightening. But broader picture, yes, inflation has peaked, but how long it's going to take to return to target is still the unanswered question. And this of course begs the question, whether or not, and this is a word, by the way, that Fed Chair Powell brought up at a couple of meetings ago about the disinflationary process. He said that he has seen it, that the disinflationary process has begun, which got markets very excited, but he was only referring to one particular component, and that's the goods component, the goods CPI. So not only are we looking at headline CPI, and not only are we looking at core CPI, but now we're also breaking it down further between goods and services CPI. Goods prices, they've been coming down because as manufacturing has opened up, there's been a lot less demand now for goods, and it also helps that China has reopened. So all the supply delivery delays have, are almost non-existent. But services prices remain very elevated. These are services, like travel, like dining out, but especially by wages, because wage growth is still very high. That's the biggest component of any company's, a service company's expenses is wages. That's the biggest component. So we're still seeing a lot of that, and we're still seeing services prices remaining very high. So this is not good news for central banks. This is what they want to see coming down next.
All right, so we got to look under the hood, not just at the headline there. What's the Fed going to do next? I guess that's the big question.
Ooh, that's really another question. I don't think the Fed knows just quite yet either. Yeah, okay, a little bit tongue in cheek there, but I think again they are staying very flexible. You know, they raised rates as expected, 25 basis points at the last meeting, and they did signal quite clearly that there's going to be one more rate hike behind the curtains, and probably going to see what happens after that. So our official call is, you know, just like that, one more rate hike, and then see how things play out, see what the impact is of you know, this like 500 basis points or whatever of tightening. The Bank of Canada, by the way, has been the one major central bank that has announced that it is on pause, and assuming that everything plays out as they expect, which is slower growth, inflation coming down, which it has been doing. They are also ready to just stay on the sidelines and to see how things play out. It's not like that for some of the other major central banks. The ECB, for example, has become the uber hawkish bank all of a sudden. You know, they've been raising rates 50 basis points. Sounds like they're going to probably do that again at the next meeting. And almost every single ECB member continues to sound very hawkish and is determined to bring inflation back down to target of 2%. The Bank of England, maybe not as hawkish, but they still have another rate hike potentially to up their sleeve. But everyone has got their eye again on that the inflation ball, and they want to bring inflation down to the 2% level as quickly as possible. And of course, having all these extra crises, you know, is not helping helping the situation much. But again, we're probably going to see a couple more rate hikes, at least from some of these major central banks, before they take a break.
Okay, well, let's turn to the housing market with rates continuing to climb. You know, I'm certainly feeling the heat, but what are you seeing here, and what are the risk factors for housing currently?
So, especially with the Bank of Canada, with that rate, you know, backdrop in mind, this could potentially be the slightest bit of potentially good news, a little bit of light at the end of the tunnel for the Canadian housing market. You know, we can say that yes, housing prices have already been plunged over about 16% nationwide. Some pockets of the city or of the country have had a bigger decline, and the average decline, as you can see from that chart, is 14%. So you think, you know, are we done? Obviously not. You know, as you can see from the line chart, there is no cookie cutter correction around in this country when it comes to the housing. Comes to previous housing corrections, they're definitely not the same. It takes an average, for example, of 6 years to recover, and from that point of view, we're only finished year one. So does that mean we have a long time to go? It's sort of hard to say, but for sure, having the Bank of Canada on pause is certainly welcome news for the housing market, but I think it's still too early to sound the all clear or the all clear bell yet on Canadian housing. But certainly this is a slight glimmer of hope.
All right, good. And let's wrap up with your final thoughts in terms of where we're headed with the markets and what investors can expect as we move forward.
You know, I think the last few weeks have shown we can probably expect even more, a lot more volatility, especially until this latest episode has been cleared up. And again, I don't know how long that's going to take, but you're going to expect it's not going to be, you know, a straight line up or down, I don't think. So expect a lot more volatility. We continue to look for a recession in terms of the economic activity. We still continue to look for for a recession in both countries. How mild, whether or not it's a hard landing, you know, that still, you know, remains to be seen. But we're looking for, you know, still overall growth, broader growth of about 0.5, 0.7% for this year. For inflation, you know, of course, you know, that's going to have a big say, but it's still going to remain sticky for some time. But we look for inflation to head back toward maybe the 3%-ish range, probably by the end of this year, towards the end or middle of next year. But for sure, tighter monetary policy is certainly helping. It's certainly helping do the job, just not quickly enough. But policy will probably remain tight. We may not be seeing, you know, 75 basis point rate hikes as we saw late last year or middle of last year. But even if we're not going to see more rate hikes, I think rates will remain elevated for some time before central banks make any changes. And at the earliest, rate cuts probably won't start until early 2024 and potentially maybe even late 2023. But it's still early to say.
All right, well, thank you for that, Jennifer. That caps off another great week of ETF Market Insights. Really appreciated all your thoughts on the economy and giving us the rundown on the overall view from the cap market side of things. Definitely very valuable, and we jam-packed it all in less than 30 minutes. So,
Thank you for having me on.
Yeah. Next week, we will be off for Easter. We'll return on Friday, April the 14th, same time, same place. So I hope you can join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.